Hello, I'm JP Powers, Chief Investment Officer at RWA Wealth Partners. Each month, we take a few minutes to look at what's shaping markets and what it could mean for your portfolio. This month, 3 themes stand out. The market's resilience as we continue to reach new highs, and perhaps some of its blind spots. How a weakening dollar has contributed to the surge in gold prices and shifted global market leadership internationally. And lastly, we'll discuss how AI is quickly rewriting the energy story. Let's start with a review of equity markets. The S&P 500 has extended this year's gains despite some bumpiness earlier this month when the president floated a renewed tariff fight with China. That quickly passed, and markets have resumed their climb higher. As we look ahead, the government shutdown has delayed the release of key economic data that would typically be impacting markets. In lieu of that data, earnings season has taken center stage, and so far, results have been surprisingly strong. While it's still early, with only about a quarter of companies in the S&P 500 reporting, sales growth is running at almost 8%, and earnings are up over 15%. And at the sector level, you can see here how several areas like technology, industrials, and financials have delivered some particularly bright results, with strong margins and better than expected guidance. Utilities has also shown significant earnings growth. But outside those sectors, performance has been more mixed. And communications and consumer discretionary names are showing pressure from higher costs and maybe some slowing demand. It's still early in the season though, and we'll need to wait to hear from names like Meta, Google, and Nvidia, who report later in the quarter and will certainly move markets when they do. Shifting gears to this week's Federal Reserve meeting. As we've covered in this space before, the Fed faces a delicate balancing act. Inflation progress has slowed, fiscal deficits remain large, and political pressure on rate policy is mounting. With all that, the Fed is widely expected to cut rates by another 25 basis points this week, despite equity markets making new highs. While the Fed doesn't want to wait for an economic slowdown to start cutting rates, it highlights the clear mismatch between returns in the market and what those at the Fed are seeing in their economic outlook. Still, it's worth pointing out that we have the highest level of rates of the major central banks, and so there is room to cut and find an equilibrium rate probably somewhere in the mid to high 3% range early next year. From there, the Fed can be more data dependent, assuming the government's open and releasing data by then. So with interest rates on the decline, the national debt expanding, and both trade and immigration policies in flux, you can see why the dollar has been under pressure this year, highlighted by this chart showing the dollar against the euro over the last 12 months. All of these factors have not just hit the value of the dollar, but have caused assets like gold to surge to all-time highs. Several contributors are at play, including central banks buying gold as they look to diversify away from the dollar. But much of it is from retail investors piling in through ETFs. But the bigger story may be overseas, as this trend of perhaps waning US leadership has triggered a significant rally in international equity markets. While the S&P 500 is up about 14% this year, outside the US, countries like Germany are up nearly 40%. China is up roughly 30%. And the seldom quoted IBEX 35 index, which represents Spain's largest stocks, is up over 50%. Cheaper valuations, earlier rate cuts abroad, and currency strength have made 2025 one of the strongest years for international outperformance in well over a decade. When confidence in the dollar fades, global capital looks elsewhere, and we're seeing that rotation in real time. Our final topic this month revolves around AI. It's no surprise that we would be covering AI again, but today I want to talk about it from a different angle. That is the rise of AI-driven energy demand. As more and more users begin to use these tools on a regular basis, the data centers powering the AI models are consuming massive amounts of electricity, and global power demand from those facilities is expected to double in the next few years. Utility companies are scrambling to meet that demand, and you may have noticed a shift in your own energy bills as a result. As you can see here, the price of residential electricity has been on the rise the last few years as these costs from utilities trying to meet the incredible demand are being passed on to consumers. So, while oil and gas prices have eased, the savings at the pump have been offset by an increase on your electric bill. And it's not likely to slow anytime soon as the demand for electricity continues to ramp up. From an investment standpoint, when we think about the opportunities that this could create, we have to look beyond traditional energy or commodity investments. The benchmark Goldman Sachs Commodity Index, or GSCI, shown here over the last year, has had an up and down run, but has done little for investors tracking that index. That's because the bulk of the index is tied to oil and not to electricity generation. The price of West Texas crude oil has actually come down materially over the last year as demand for other sources of energy has picked up. This surge in electricity demand is reviving interest in nuclear power. And uranium prices have caught the attention of investors. But you can see here that the results have just not been there. Instead, the winners are at the actual company level, which is where we choose to place client dollars as well. Companies like Oklo, a nuclear power operator, and Cameco, who makes uranium, have seen their stocks appreciate rapidly in this environment, far outpacing the results of the commodities in this space. For energy investors across the globe, this marks a shift from oil barrels to electrons as AI reshapes not just productivity, but power consumption itself. To sum up, economic and consumer resilience continues to win over the equity markets. Gold's rally signals waning confidence in the dollar and perhaps the US as a whole. And international markets are taking leadership for the first time in many years. And while AI is transforming technology, it's also rewriting the global energy story. If you'd like to discuss how these shifts could impact your portfolio, reach out to your RWA team or visit us at rwawealth.com. Thanks for joining me, and I'll see you for our next update soon.